Our next speaker talking about investing in a time of climate change is Inge West. Inge West is a home girl who's based over the seas, as we would call it. She grew up in Cape Town, an avid musician herself, fluent, if I could call it that, fluent pianist, as well as a clarinet player, has an eclectic taste for music. So when I asked her who her favorite musician was, she gave me a name that I can't even pronounce, so I won't mention it. But she's someone who loves music, good at music, and enjoys traveling. So the opportunity that she had, starting off with Alexander Forbes in Cape Town, then working with Alexander Forbes in Johannesburg for a few years, and now moving to Mercer overseas, has really given her that opportunity to travel and see the world and enjoy the things that she enjoys. So
Good morning, everyone. I trust that you've enjoyed the sessions that have occurred prior to this. I wanted to take a look at the screen, and I'm not sure if you know what these stripes are representing. But if we look at the stripes, we're basically looking at the overall average global temperatures from 1850 to 2017 over time. And what we can see is when we look at the temperatures on the far left-hand side of the screen, we're actually seeing that currently the temperatures that we are experiencing is in excess of 1 degree above pre-industrial levels. And what you can also see from the chart is that we've actually been experiencing the hottest years on record, with the last 10 years that are shown to be the hottest 10 years recorded in history. So what this is ultimately telling us is that we are experiencing global warming and climate change is becoming a reality. And with these increasing temperatures that we are seeing, there is a greater prevalence in terms of both floods, droughts, extreme temperatures, and wildfires. And the reality is, if you look at the current amount of emissions that we are currently producing as a global economy, basically means that if we continue on this current trajectory, in the next 30 years, we're going to be in an environment that is outside of human experience. So in order for us to try and address these changes, and we look at what's been stated in, for example, the Paris Agreement, which aims to limit climate change and global warming up to a limit of 2 degrees by the end of the century, we really need to focus on investing in low-carbon solutions. And we see that there has been a significant amount of developments over the last few years, specifically focusing on transitioning to a low-carbon economy through, for example, infrastructure solutions, as well as other technologies that focus on energy efficiency, managing pollution, and also in terms of agricultural technologies. In fact, actually, if we look at the New Climate Economy, which is a global organization that focuses on climate and the economy, they have estimated that between 2015 and 2030, we actually need about $90 trillion in terms of new infrastructure spend. And that's basically the same amount as the current amount of infrastructure stock that we currently have in the market. And this basically means that over the next few years, we actually need to double the amount of investment into infrastructure, specifically focusing on renewable energy, to get it to a level where it's sitting at about $6 trillion per annum. So given this need for these technologies, we do expect that there will be providers out there in the market that will work on developing solutions to these challenges. We've also seen that, given the environment that we are facing, that there has been a significant amount of legislation that has been promulgated in order to try and assist in ensuring that countries adapt to climate change. And what you can see is that basically, particularly rising up to 2015, when we had the Paris Agreements, there's been a significant amount of regulation. We now see that there's over 1,200 relevant laws globally across 164 countries. And we have recently seen at the start of this year in South Africa as well, we've recently implemented a carbon tax. So we've looked at briefly some of the risk elements. We've also seen that there are opportunities from a return perspective. We've seen that there's been regulatory drivers, but we're also seeing that there's been a greater focus being placed on corporates in terms of their overall responsibility, and also focus being placed on asset owners in terms of what their fiduciary duty is in terms of looking at climate change. And this is why at Mercer we've been looking at climate change for almost a decade already now. We've really been looking at how do we understand these issues so that we can work with clients in order to address these issues within their portfolios. And we started out back in 2011. Sorry, in 20, I think I need to slow down a bit. We started back in 2011, where we first looked at the impact of climate change on various asset classes, and then moved on to look at it at a portfolio level. And more recently now, we've released our Investing in a Time of Climate Change, the sequel report, which goes a little bit further to look at what is the impact of climate change under various different climate scenarios. And with this report, we've also produced a portfolio tool, which is known as the Climate Risk Analyzer, which actually enables one to run your portfolios and to try and assess the impact that climate change will have on overall investment returns. So when we look at climate change, it is a very complex topic, and partly also because it spans over multi-decade timeframes. As I mentioned earlier, in terms of the Paris Agreement, there is a focus to try and limit global warming to 2 degrees, although there have been some other coalitions out there that have actually stated that we actually need to keep it below 2 degrees. But if we look at the current trajectory that we are on a pathway to a 3-degree economy. And if we look at some of the risk factors that play out from climate change, the most obvious, I guess, would be physical damages, and that really relates to the impact of natural catastrophes and also how this then impacts on the availability of resources. And we'll largely see that these risk factors will come into play at the second half of this century. But in the shorter term, over the next couple of decades, there is a focus on what we refer to as transition risks, and also you can refer to it as transition opportunities, in the sense that, for example, we are expecting to see a significant amount of spending being placed on developing technologies to help us to move to a low-carbon economy. We also expect changes coming from various policies that are going to be put into place in order to try and address climate change and various technology developments as well. So, as Johnny mentioned earlier, I think you said what is measured can be managed. And I think the real purpose of the modeling that we've done and the report and the research that we've done is really to give investors a starting point in terms of understanding what the potential impact of climate change can be on their portfolios, so that they can look at how they can make different investment decisions around these. So if we look at the actual modeling that we've done, we firstly partnered with Cambridge Econometrics, and we used what they refer to as the integrated assessment model. And basically, it looks at a number of scientific, economic, environmental, and energy data, and over 2 million different data points. And it basically then looks at these various risk factors. So as I mentioned, spending. What is the spending going to be like in order to ensure that countries are able to comply with the targets that they've set in terms of the Paris Agreement? In terms of transition risks, what are the spending that's going to be needed in terms of developing various technologies to address climate change, and then also in terms of the risk factors, impact of physical damages, and how that leads into the availability of resources. So what we do is we basically look at how sensitive various asset classes are to each of these risk factors over various different climate change scenarios in order to be able to determine the overall return impact that it can have on various asset classes and your overall portfolio. So climate change scenarios is an important input into the overall modeling exercise, and we look at it across both a 2-degree scenario, which is in line with the Paris Agreement, as well as a 3-degree scenario, 4-degree scenario. And maybe just to start off where we currently are at the moment, currently we are seeing that fossil fuels represent about 80% of our energy mix, and we are currently experiencing temperatures that are 1 degree above pre-industrial levels. And this has led to sea level rises, and I mean, we say there that half the Great Barrier Reef is dead, but what that really means is that we are losing a large portion of biodiversity, and also that's very important in terms of when you look at protection against flooding. So that's where we currently are now. If we want to have a chance of reaching a 2-degree economy in line with the Paris agreements, it means that overall carbon emissions need to peak next year. It also means that, for example, coal needs to be phased out in the next 30 years. And even if we are able to do this, we'll still see sea level rises of about 50 centimeters and droughts that last on average 4 months longer than we've seen in the past. And when we look at the 3-degree and the 4-degree scenario, that's really outside of human experience. In a 3-degree scenario, you see that there has been more commitment made to overall transitioning, but you still see that fossil fuels are about 80% of the energy mix. So while their coal has gone down, there'll be a greater use of other fossil fuels such as oil and gas. In that circumstance, you see, for example, 58 centimeter sea level rises and irreversible damages and 30% less water availability. And when we get to a 4-degree scenario there, it's really basically saying that we have not really tried to do anything to try and lower our emissions, and emissions are still increasing. And there the overall physical damages are just irreversible. So if we look at sort of the path that we're on, so as I mentioned, Paris Agreement says we should try and get to a 2-degree economy. There are other prominent organizations out there that have said we need to actually limit it to 1.5 degrees. But when we look at the various policies in place from governments in terms of what they are trying to do to address climate change, we can actually see that we are sitting at more of a level of around 3 degrees above pre-industrial levels. So again, this is not ideal for us at all. And it's important to just keep this context in mind when we look at the findings of the overall model that we've done and the results of the model. So the first key finding of the research that we've done, and we basically modeled, this is a global growth portfolio, and we've basically looked at the impact under various different climate change scenarios over the next 10 years. And what you can see is that under 2-degree scenario, you're expected to get 11 basis points of an additional return, taking into the climate impact over the next 10 years. Under 3 and 4-degree scenario, the returns will be negative. And more importantly, though, if you look at it over a longer term framework up until 2050, you'll see that in all scenarios, never mind what outcome actually plays out, that returns will be negative. So this is basically showing that we do need to work towards a 2-degree economy. Now, I do want to highlight at this point, though, that we do, if you look at the numbers on the screen, they do seem very small. But I think one needs to also keep in mind that we are looking at this over multi-decade time periods, and also there are various assumptions used in the modeling. So for example, in the modeling, you are needing to sort of estimate what are those physical damages going to be all the way out to 2100, for example. And it's very difficult to actually estimate these things. So in our view, we believe that a lot of the assumptions, particularly around physical damages, are actually underestimated. The second key finding from the research that we've done is actually a positive finding. And it's basically saying that, firstly, if we just look at the expected impact on return to 2030, we do see that transitioning to a 2-degree economy will be positive for portfolios. And this is largely given the fact that there will be more investment in renewable energy technologies. These technologies often improve efficiencies and the like, and that's why we look at that additional return as a low carbon transition premium. But then if you are actually further moving into sustainability investment themes, we can actually see that that number can almost double to about 29 basis points per annum in additional return over the next 10 years. The third finding from the report is basically looking at some examples around different industries, sectors and different asset classes. And I think this is where the results of the model really come through very clearly, is that there are certain sectors that will do well in terms of the overall transition to a low carbon economy, but there also will be sectors that will struggle somewhat. And I just want to touch on what I find quite an interesting point, particularly when we look at the difference between the returns coming or expected from coal and oil and gas over the next 10 years and over the next 30 years. If we just go back to the next 30 years, you can see that on average the annual return is expected to be the same. And that's because, in a 2-degree scenario, in the next 30 years, we would have actually transitioned away from a lot of fossil fuels. And that's why, irrespective of whether you're in coal or oil and gas, it will be negative for your portfolios. But it's interesting to see in the shorter term, though, over the next 10 years, for example, you'll see that coal actually does a lot worse than, for example, oil and gas. And I think, this is something key to understand, is that when you look at your overall fossil fuels, there's obviously different carbon intensities across different fossil fuels, with coal being the most carbon intensive, followed by oil, and then followed by gas. And if we are having to move away from coal, in the immediate term, in terms of the overall transition, it will mean we would need to use some forms of somewhat cleaner fossil fuels, being your oil and your gas. So gas is actually seen to be an important part of the overall transition to a low-carbon economy. And as Junji actually mentioned earlier, there is going to be a lot of focus on energy companies. And what we've actually seen, like when you look at a lot of the oil majors, a lot of them have already realized that they need to start changing their business models. And a lot of them are actually moving from oil companies into energy companies, and actually moving into renewable energy, and also looking at renewable forms of fuel as well. Just in the terms of looking at various asset classes, again, the key theme, I think, is that infrastructure, specifically if it is a sustainability theme, is expected to be the winner in a 2-degree scenario. And that is largely given the fact that it is expected to have a lot of exposure to renewable energy. The fourth key finding, and this is one of the key elements from our overall study in terms of how we've progressed our research over the last few years, is that in the past we've just looked at the impact of climate change over various time periods. We've now gone further in terms of looking at it under different scenarios, but we've also realized that the returns that I've shown you over time have been neat annual returns. And the reality is that we don't expect this to happen. We expect there to be sudden shifts, changes in market sentiment, changes in understanding of which scenarios we are on track to achieve, changes in physical damages impacts. And so what this model has actually allowed us to do is to actually stress test portfolios to say, yes, we've looked at the modeling over a period of 20 years, 50 years, until 2100, but what happens if suddenly all of that has to be shifted now, and we bring it back and capitalize all those impacts into a 1-year period. And there you can interestingly see that the effects can be a lot more significant. So the model allows us to do that as well. So just to sort of summarize the climate change work that we've been doing and why we feel that it is beneficial for investment teams and investors and asset owners, is really again to get to a starting point where you understand the overall exposure of your portfolio to potential different climate change scenarios. And this can be very helpful in terms of then being able to look at your overall strategic asset allocation, prioritize certain asset classes, look at the sector exposure that you have, and also stress test your portfolios to see how the overall impact may change given different outcomes. And I just want to sort of put it into more of a context from an investor perspective or an asset owner's perspective, and maybe bring it in a little bit in terms of, how does climate actually fit in with the overall consideration of ESG within your investment strategy. And at Mercer, we generally like to look at it as adopting a sustainable growth framework, whereby we focus on your beliefs, your policy, processes, and then your portfolio. So really ensuring that you have clearly defined investment beliefs, particularly around issues such as climate change, incorporating them into your investment policies, and then looking at how can you actually implement this through putting various processes in place within your portfolio. And a number of ways to really do that. And again, we focus on, I know there's 4 sites, and now I can bring in the 4. We've got 4 key pillars. So firstly, it focuses on integrating climate considerations into your portfolio. So from a manager selection perspective, ensuring that you are asking your asset managers what they are doing in order to consider climate change within their portfolios. There are other tools available as well, so you could use climate scenario analysis to look at the overall impact from climate change on your portfolio at the top-down level and help with your overall setting of your strategic asset allocation. But you can also, for example, look at doing a bottom-up analysis, so looking at the carbon footprinting of your portfolios and understanding what are the drivers, what are the companies that you are investing in that are driving the emissions of your portfolios, and looking at that relative, for example, to an overall benchmark. The second thing is really around investing in sustainability themes. And I know that generally during the course of this morning there has been a bit it's been evident that there is maybe a bit more constraint opportunity set in terms of that. But I do believe that as there becomes a growing focus on climate change and in adapting to climate change, that there will be more solutions that are developed that will address this, and I therefore believe that it will be important to find those managers that are looking to address those solutions. Thirdly, we look at engaging with stewardship, and this is another area that Jonji spoke to about earlier, particularly given the fact that the market is very small. So really, engaging with your asset managers and ensuring that your asset managers are engaging with the companies that they are investing in and asking them what they are trying to do in order to try and, for example, lower their carbon footprint or become more efficient in their businesses. And another way here is, when we look at stewardship, it focuses on engagement as well as voting and ensuring that the asset managers who are voting on your behalf are voting in line with encouraging greater disclosure of climate practices by companies. As I mentioned with the example with the oil majors, we are seeing that a number of them have started to try and look at ways to be more carbon efficient in some of their operations, or to look into new technologies and become more energy focused rather than just on your more intensive fossil fuel resources. So engagement, I think, definitely can help. And then finally, and it's not always possible, but this is what we are seeing to a very big extent globally, is around decarbonizing your portfolio. And decarbonizing your portfolio, as I mentioned earlier, does not necessarily mean just divesting from all fossil fuels. In actual fact, globally, what we are seeing is that while there is a focus away from coal, a lot of investors still believe there is opportunity in oil and gas companies, and that they play an important part of the overall transition to a low carbon economy, and that through engaging with them, which obviously they need to have an investment with them, can actually have a positive impact. Also to note that there are obviously other sectors within the economy as well, so not just around fossil fuels, that are high carbon emitters, so some other industrial companies as well. So it's really about looking holistically at your portfolio, looking at the tools that are available, and then trying to integrate these climate considerations into your overall investment process. Thank you.
Thanks, Inge. I think the slides were bright for me sitting over there, which might be a factor of climate change as well. Definitely kept us awake after the eats. But thank you for your insights, and that there were a few questions that had come through. And when we were preparing to come through to this session, she mentioned that she has two people in the audience who used to approve her leave. And one of them has actually asked the first question. And he has said, "We have recently experienced some activism in South Africa against carbon investing. The view of activists is to screen out carbon investments and avoid them. But how can we apply this in the South African context?"
Well, in terms of what we're seeing happening globally, if we want to move away from carbon, you want to move away from carbon. And I think the difficulty here is that we don't have any investment portfolios or strategies available in the market that are applying those screening criteria. But I think that there are some, particularly in the passive space, with some providers out there that are doing that, and that's how you get out. I mean, if you have a segregated mandate and you want to limit your exposure to carbon, it's as simple as just excluding it. Like I've said, like globally, the focus is on moving away from carbon. There's no question about it. I know it's very difficult to stand up in South Africa and say this, but that is what we are seeing globally, because there is no sort of way out in terms of getting away from those emissions. We don't want to be naive in terms of saying getting away from all fossil fuels. As I mentioned, there are some oil and gas companies that are working on changing things. But if we need to get out of coal, we need to get out of coal. Look, and this is just speaking from a sustainability perspective. So obviously the investment return implications in terms of if there's certain benchmarks that one is managing your funds against and things like that, then, you know, those are additional considerations. But from a sustainability perspective, you exclude them.
And maybe just picking up on that last comment in your response, the question that has come here is climate change does impact companies' bottom lines, which is what people care most about. What are your thoughts on how to make sure that people understand the need to incorporate the two, or that the two go together?
Well, I think that's really been the purpose of this report, really to try and like quantify the potential impact of climate change on portfolios. And similarly, so what we're seeing globally, the Financial Stability Board has developed a framework which is known as TCFD, which is the Task Force for Climate-Related Financial Disclosures. And basically it's asking all corporates to actually disclose their potential impact of climate on their businesses. And they are seeing that there is a negative financial implication from that. So I think, you know, if we are able to quantify it through work that we've been doing like this, it is a way to sort of bring the two together.
Okay. And this is probably more specific to your day job. Given all the noise in the global markets relating to the potential US recession, trade wars, Brexit, etc., how is Mercer specifically spearheading the fight for climate change risks to be accommodated in portfolios?
So, I mean, in terms of, and one thing I actually forgot to mention earlier though, so we are big activists in terms of climate change. So we've signed on to a number of coalitions globally to support various climate change initiatives. We've signed up to the TCFD as well. So as an example of that, what we've basically said is that all the portfolios that we manage on our clients will be doing climate change scenario analysis. We also monitor all these portfolios in terms of their overall carbon footprint. We look at this relative to the benchmark. We work with the portfolio managers to actually understand where are the risks, so that they are thinking about how are any manager changes that are coming into the portfolio actually going to contribute to the overall carbon of the overall portfolios. So those are some of the more tangible things that we are doing. And given the partnership that Alexander Forbes has with Mercer as well, we'll be actually over the next few months be running the main portfolios of AF to actually understand the overall impact. Because one thing to bear in mind, the research that has been shown today is really based from a global perspective, and we obviously need to acknowledge that regional allocations are significantly different here, as well as asset classes and sectors and things like that. So I think the main thing is, again, starting to understand where you are at, what is your exposure, and then looking at what you can do to try and mitigate it.
Thank you very much, Inge. A big hand for Inge.